Liquidity is a fundamental concept in Forex and any financial market. Despite its significance, it often goes unnoticed by many beginner traders. However, understanding what liquidity is and how it impacts your trades is crucial for improving your results and making more informed decisions in your trading strategies. In simple terms, liquidity refers to how easily you can buy or sell an asset without significantly affecting its price. In the Forex market, where currencies from all over the world are traded, liquidity is one of the most defining characteristics. This market operates with an average daily trading volume of over $6 trillion, making it the most liquid market in the world. But why is liquidity important? First, high liquidity means there are many buyers and sellers in the market, making order execution easier. For example, if you want to buy euros and sell dollars in a pair like EUR/USD, you're likely to find counterparts quickly due to the pair's high liquidity. This results in faster execution and tighter spreads, reducing transaction costs. On the other hand, in exotic or less traded currency pairs, liquidity can be lower. This leads to wider spreads, slower execution, and occasionally price slippage. For this reason, traders often prefer trading major pairs like EUR/USD, USD/JPY, or GBP/USD, which offer high levels of liquidity. Liquidity also varies depending on the time of day. For instance, during the overlap of the London and New York sessions, market activity peaks. This is due to the convergence of traders from the world's major economies. In contrast, during the Asian sessions, some pairs may experience reduced activity, particularly those that do not include Asian currencies. An interesting aspect of liquidity is how it's affected by economic and political events. Interest rate announcements, employment reports, or monetary policy decisions can trigger sharp spikes in volatility, even in highly liquid pairs. In these scenarios, the market can become unpredictable. While liquidity remains high, sudden movements may cause slippage and unexpected price changes. For traders, understanding and leveraging, liquidity can make the difference between a successful and a frustrating trade. Trading during periods of high liquidity allows you to enter and exit the market with greater precision. Additionally, lower spreads during these times reduce overall costs. However, it's equally important to stay cautious during high volatility events as they present additional risks. In conclusion, liquidity is the engine that keeps the Forex market alive. Learning to identify when and where liquidity is at its peak is an essential skill for any trader looking to optimize their results. So, next time you plan your trades, consider not only the currency pairs but also the market's liquidity conditions and timing.